Hello, today we will be analyzing the Home Depot financial statements and the related ratios according to the liquidity, solvency, profitability, and the related revenue trends of the overall industry. For the liquidity analysis, Home Depot carries a high amount of inventory on hand, and this creates additional risk for the entity since it creates the potential for the inability for Home Depot to turn over their inventory in case of potential external factors. So if there were any reason that Home Depot were unable to sell the majority of their goods or services, this would create the inability for Home Depot to cover their current liabilities. You see this shown in their quick ratio and their cash ratio also, as they have little cash on hand. The calculated cash ratio for the first and second quarter of 2022 was 0.08 and 0.09 respectively, and the quick ratio was 0.24 and 0.28 respectively for both of those quarters as well. This is attributed to the increased amount in their inventory, which you see in the quick ratio since this is so low. And you also see that the current ratio is actually above 1 since you take that inventory back into account. This is good in terms of the overall financial and statement strength in terms of liquidity, since a current ratio over 1 means that Home Depot is able to cover their current liabilities with their current assets. And like I said, that's mainly attributed to the inventory that they have on hand. As far as the solvency, Home Depot has very little equity, and they actually reported a deficit for both Q1 and Q2. The inventory does cover many of the solvency concerns since this equity was at a deficit for both of the first two quarters. This is related to the potential for additional financing that Home Depot could explore in the future, and they could provide additional shares to be purchased to stockholders in order to increase the amount of revenue or cash on hand that they could have related to this equity and allow that for additional investment within the business. As far as the profitability is Home Depot, the return on assets is greater than 5% for the first two quarters, which is pretty in line with the overall industry. This is efficient in terms of the return that they're able to generate on their current asset base, as well as their net profit margin is also average for the overall industry. However, the negative return on equity that was asserted for the solvency analysis is a hindrance in terms of the equity deficit that Home Depot is also reporting. However, that's also an area of improvement that could occur in the future. As far as revenue trends, Home Depot's main source of revenue is their building supplies. If you go into any Home Depot store today, you're mainly going to be purchasing the supplies that are found in their overall warehouse in their brick and mortar stores. Their secondary source of income is typically the home improvement services, which are contracted out through external vendors that are also partnered with Home Depot. And the additional expenses that are reflected on the financial statements can be attributed to their operating costs in terms of the labor and additional expenses taken to run those stores and the selling, general, and administrative costs that Home Depot could incur on an annual basis. Overall, Home Depot does have strong financial statements and strong financial ratios. However, there are some risks that could be an impact to potential investors, as there are in any company. So overall, Home Depot would be a potentially good investment for any investor, and they're very solid in terms of their overall position for their industry.